Thanks very much, Mr Deputy Speaker. Look, I rise to speak on this package of bills, and I have been listening intently to the member for Rankin's contribution. And it's always easy being an armchair expert. After 6 years in government and delivering 5 of the biggest deficits we've ever had, or the 5 biggest deficits we've ever had, it's very easy now to sit back and claim that the former government had a path to eliminating multinational tax avoidance. If it was so easy, jurisdictions around the world wouldn't be grappling with these issues, as all jurisdictions are. So for the member for Rankin to claim that it was stitched up and the package of changes that the Labor government had proposed would for all time end multinational tax avoidance, well, that is obviously ridiculous and from somebody with such little credibility shouldn't be listened to. The two aspects of the number 4 bill that I'd like to talk about really revolve around the proposed thin capitalisation changes and the changes to foreign dividends. And I'd also note that the member for Rankin went on and criticised those changes, but they are going to support them. So I thought that was quite interesting. It's always difficult in a world of mobile capital to strike the right balance between ensuring that we have an effective and efficient tax regime, but at the same time doesn't disincentivise multinationals from investing in our country. And in my former life as a tax lawyer, the thin capitalisation rules was something that every single multinational taxpayer had to think about. And contrary to popular belief, or contrary to the contributions of those opposite, the thin capitalisation rules, when they were first introduced by Treasurer Costello in 2001, really just were in place to set a cap on which a company or a multinational could be capitalised in Australia before debt deductions became denied. So it's a tool that can be used to impact multinational tax avoidance, but it wasn't necessarily the primary reason. The changes in Schedule 1 to the bill tighten the debt limit settings in the thin cap rules to ensure that multinationals don't allocate a disproportionate amount of debt to their Australian operations. It also increases the de minimis threshold to minimise compliance costs for small businesses. And this is actually a really positive change. For businesses that don't have a debt deduction above $2 million, they don't need to think about the thin capitalisation rules, and that's a really outstanding, I think, measure to try and encourage smaller to medium companies offshore looking to set up in Australia to do so. We also, in Schedule 1 to the bill, introduced some technical changes or introduced a new worldwide gearing debt test for inbound investors. It's one of the tests that, in practice, is, in my view, more susceptible, or has been in the past more susceptible to being abused. These measures have strong links with the government's initiative on base erosion and profit shifting, and we've seen the outstanding work that the Treasurer has done with the G20, and contrary to the member for Rankin's contribution, it is tough work, it is difficult getting jurisdictions with very, very different tax regimes together and to agree on just about anything. It is really tough. So I take my hat off to the Treasurer for doing such an outstanding job thus far with respect to the G20. So with respect to these initiatives, we believe that the current thin capitalisation rules are too generous compared with the actual borrowing levels of companies with truly independent arrangements. And other speakers have, in a sense, spoken about the evolution of those debt levels that companies and multinationals have had over the last 13 years of the thin capitalisation regime. It also addresses our view that ultimately base erosion and profit shifting is eroding our corporate tax base and therefore penalising all other taxpayers, because for every dollar we can't collect from a multinational is, quite frankly, a dollar that we need to collect from other taxpayers. In our view, taxpayers who genuinely require higher borrowings will continue to have these recognised through the operation of the arm's length test. So irrespective of the safe harbour rule in the thin capitalisation rules, if there are really good commercial reasons that fit into your industry profile for a multinational or any company to carry debt above the thin capitalisation levels, to the extent that that can be objectively proved, a company can of course carry that debt. These changes are really an outstanding way, in my view, to address them. I think it strikes the balance, and the changes to the debt-to-equity levels that are allowable, as other speakers have mentioned, reduce the maximum statutory limit from 3 to 1 to 1.5 to 1 on a debt-to-equity basis. That's for general entities, general taxpayers, and it also reduces it from 20 to 1 to 15 to 1 on a debt-to-equity basis for non-bank financial entities. So I think these changes strike a sensible balance. Again, it's not as simple as the Labor Party would make out, that you just go in there and bash multinationals over the head and tell them that they can't deduct any debt in Australia. That would have obviously devastating impacts on our economy. So we have to, unlike the armchair experts opposite, actually come up with sensible changes. In respect of Schedule 2 to the bill, this schedule amends some aspects of Section 23AJ, which is an exemption for foreign non-portfolio dividends by Australian companies. In our view, it amends the exemption to address a flaw in the system, which effectively allows the exemption to apply to a debt instrument, in effect to ensure that we have greater integrity in the thin capitalisation system. So rather than focusing on voting interests of a particular interest that an Australian entity might hold in a foreign entity, it will look at a participation interest. And I think that, again, is sensible, and I'd say most corporations and tax advisors would believe that that is a very sensible change. At the same time, though, we don't want to impact Australian companies expanding offshore. It's absolutely outstanding for our great Australian companies, and many of them are iconic, who are the best at what they do. We want them to set up offshore, and we want to ensure that we have a tax system that can appropriately cater for the fact that often, and in many cases, those Australian companies will need to raise debt in Australia in order to fund offshore expansions or acquisitions. So again, the Labor Party in some ways think in a perverse way that we should whack these Australian companies, but these Australian companies are a success story. So I think, again, the changes to Section 23AJ, or the non-portfolio dividend exemption, strike that sensible balance again. Schedule 3 ensures that foreign resident capital gains tax regimes operates as intended by preventing the double counting of certain assets under the principal assets test, and I won't go into much detail. I don't think it's controversial, but again, it cleans up some issues that have really been there since the foreign resident CGT regime was put in place. And the foreign resident CGT regime just basically tries to have the effect that if a foreign entity is in effect making a gain on the sale of Australian real property, that they pay tax on it in Australia, even though they may not have a tax presence in our country. I think Schedule 4 to the bill, again, is an outstanding piece of policy. The Labor Party have criticised it, and the member for Rankin criticised tax receipts. But I think, again, what is wrong with telling the Australian people and outlining them in a transparent way where their tax dollars go? And I think it probably highlights the divide between both sides of the House. I believe that government expenditure is ultimately money that we have spent of taxpayers that they have entrusted with us. I get the impression that for many people on the left of the Labor Party, they think that that's government's money. But if you come to it from where I believe is a sensible starting point, which is we are spending taxpayers' money on their behalf, it absolutely makes sense for us to be extraordinarily transparent with those taxpayers on where their money is going. And I think when I hear criticisms, like I did from the member for Rankin of this policy, taxpayers would be wise to be quite suspicious of anybody that criticises this form of transparency. What is wrong with this parliament, in a very clear way, letting Australian people know where their money goes? The tax receipt will include a notional breakdown of the taxpayer's personal assessment into various categories of government expenditure, and that will be decided by the government of the day. But those categories and those breakdowns will be something that the Australian public and Australian taxpayers will be entitled to scrutinise. Approximately 10 million taxpayers will receive a tax receipt for the 2013-14 financial year, and like the member for Bowman, I think it's a nice way of saying thank you. Thank you to those 10 million taxpayers for everything they do in funding all of the necessary aspects of government activities, and in an egalitarian society, helping people who are less fortunate and who need that support, in many cases only for a short period of time. Most of those taxpayers will have received some help in their life from other taxpayers, and then they get to a point where then they start giving back and providing help to others. But I think saying thank you in the form of a tax receipt and transparency is a good way to go. In respect of the Measures Number 5 bill, I'll just quickly, in the remaining time, touch on the three aspects of this bill. And again, I think sensible tax policy. Schedule 1 of the bill abolishes the mature-aged worker tax offset from 1 July 2014. As members opposite have noted, the Labor government started to phase out the offset by restricting access to it for taxpayers born before 1 July 1957. And look, we've accepted that the mature-age worker tax offset is complicated. It's not really well understood and in our view isn't a cost-effective way of encouraging continuing engagement in the workforce by mature-age workers. Importantly, though, savings from abolishing this offset will be redirected to the government's new Seniors Employment Incentive payment called Restart, and this payment will provide a clear long-term incentive for employers to hire and retain mature-age Australians and help them overcome discrimination. In this sense, Restart is a subsidy of up to $10,000 and will be available to employers who hire a mature-age job seeker aged 50 years or over who has been receiving income support for a minimum of 6 months. The Restart program will help mature-age Australians to re-enter the workforce, and around 32,000 mature-age job seekers per year are expected to benefit from the subsidy. So redirecting the funds from or the lost revenue from the mature-age tax offset to the Restart program, I think, is an outstanding policy and will ultimately help us reach the objective of more senior Australians in work. Schedule 2, it's been spoken about, which is abolishing the seafarer tax offset, which provided a refundable tax offset to Australian shipping companies for certain salary and wages of seafarers. I think it ultimately benefited a couple of hundred seafarers, and this really was just a part of Labor's shipping reforms, which were really just a sop to the Maritime Workers Union, and that's why ultimately this is bad policy and needs to be abolished. And finally, Schedule 3 to the bill amends the Income Tax Assessment Act to reduce the rates of the tax offset available under the R&D tax incentive. The refundable and non-refundable tax offset rates will be reduced by 1.5 percentage points, from 45% to 43.5% and from 40% to 38.5%, respectively. And these changes are really just consistent with the government's commitment to cut company tax rate. So ultimately, a broad package of changes cleans up a lot of the issues that have been really legacy problems that weren't dealt with by the former Labor government, and I think ultimately good tax policy for the country.